There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along to get you up to speed on the details from today's session. I'm going to start with the major averages here, and the Dow recovering a little bit by the end of the day, up 120 points or so, about a fifth of 1%. Remember the trajectory of the day, right? And it's probably shown more clearly in the S&P 500, which at one point was up quite a bit, then dipped into the negative, then finishing higher by about 0.4 of 1%, so off the lows of the session. This following the various trade headlines. First, a court blocking a wide swath of President Trump's tariffs, some still in effect, including sectoral tariffs. Then an appeals court coming in and blocking the block, at least for now. In other words, the tariffs still remain in effect while that case goes to appeal. So still, the tariffs perhaps weighing on the market, or at least the base case of the tariffs weighing on the market. The NASDAQ finishing higher as well by about 0.4 of 1%, but it too finishing well off the highs of the session. Jared's got a closer look at the action.
Thank you, Julie. Great recap. Nvidia's in the rear view, so that major catalyst off the table right now. And tariffs, they didn't really do too much damage to the market. So green closed despite well off the highs there. And I'll just show you the VIX. I'm going to center on the VIX volatility index with Josh in about 30 minutes here. But you can see it was down today, holding below 20. We can see that in some other markets. And I'll just show you quickly here the 30-year yield down 5 basis points to 4.92%. So edging away from that 5% line that was causing some hiccups last week. And let's check out the sector action. Only communication services in the red there. That's an Alphabet and Meta story, but we'll dig into that in a second. Everything else in the green, but as you will notice, real estate here at the top, that's defensive, as is utilities, as is healthcare. So a little bit of a defensive setup to the bullish action today. Tech had been leading in the early market, and that was thanks to Nvidia. You can see that print right back there, up 3.25%, but tech lost a lot of momentum over the day. I did mention that communication services was down, Alphabet down 0.3%. That's part of the deal. Apple also, which is tech, that was down about 0.25%. But for the most part, a little bit more green than red. Broadcom also up 1.06%. And if I put a one-year chart on there, you can see it has this nice rounded base, and it looks like it wants to break out. Might need a little bit more time to form a handle there. We'll have to see what happens, but Broadcom testing its all-time highs right now. I'm going to finish here on some of our leaders, and guess what? Biotech was the winner today. So I got two biotech ETFs up at the top, up about 2%. And after that, we got Korea. China did well today. Regional banks, home builders, which have been kind of downtrodden for some time now. Solar energy and the Magnificent Seven. On the bottom, what did not work today? Bitcoin down about 1%. Also IPOs and software and small tech. ARK Innovation Fund was down 2/3 of 1%. Back to you, Josh.
Thank you, Jared. Well, for more on the market action, we're joined now by Empower Chief Investment Strategist Marta Norton. Marta, it's good to see you. So I think, Marta, we got to start on the bouncing ball of tariff headlines. You know, we have a court step in, they block a wide swath of Trump tariffs, market rallies, right? But now, throughout the day, we then saw them give some of that up. Now we hear an appeals court temporarily pausing this decision to invalidate the levies. I think investors are trying, Marta, to make sense of this. How are you, as a strategist, trying to make sense of this and what it means for the market?
I love the analogy of a bouncing ball. That's absolutely what we saw today, and really what we've seen since April 2nd. We, of course, saw these massive reciprocal tariffs go into effect, and then we've seen pauses, we've seen delays, and everyone's kind of on pins and needles waiting for what the actuality of the trade deals look like. And I think we can get that sense from the market, that we've stepped back from the brink and we see the market recovery go alongside that. And now we're at a point where we're trying to ascertain where exactly does that tariff level fall out. And I think the reality as we look at today is there could be a longer tail in even determining what the rules of the ground are as we work through these appeals processes and the different functions that the Trump administration is relying upon to put the tariffs in place that it wants to see.
Hey, Marta, it's Julie here. All of that said, it doesn't seem like there is a huge amount of fear or concern or worry built in about tariff outcomes at this point. What is your sort of, I mean, do you even have a base case, I guess, at this stage, because things are still kind of up in the air?
Well, you have to acknowledge a wide range of outcomes when you have these kind of variables that are so hard to predict. Certainly that's the case. And I would also acknowledge that the market doesn't show a lot of fear. I mean, if you take a look at the recovery that we've seen since the initial sell-off, we've essentially done a round trip. So most of the market now is back up to the more extreme valuations that we saw heading into April 2nd. And so you could argue that the market is really focusing on the positive range of outcomes and not really accounting for anything that could go wrong on the tariff front or really any other area in particular. So I guess as I take a look at the market today, I would argue that there's just not as much margin of safety as I would like to see in this environment.
Marl, I'm curious to get your take on the economy as well today. We got GDP data today, another look at Q1. I know it's old news, but another a negative print, personal spending revised lower. Your take on the economy, Marta, where we are and where you think we're headed?
Well, a few things here to call out. First of all, just that hard data narrative has remained largely positive. So to the point, yes, GDP is showing some softening and especially, reflecting the import surge that we saw. But we are seeing inflation prove a little bit more stable than folks had anticipated. We're seeing the labor market continue to show signs of resilience. And of course, we're coming out of this very strong Q1 earnings season. But I think the reality is that the trend, regardless of which one of those variables that you're looking at, the trend is largely to the downside here. So we have a nice buffer from where we're starting from on the economic side, on the earnings side, but we do expect the uncertainty that we're in and the concerns around a more protectionist policy broadly to have an effect on the economy.
Obviously, we saw those strong numbers from Nvidia that helped buoy those shares, and there's been a lot of attention on the Magnificent Seven more broadly, maybe excluding Tesla for the moment, right? We have seen valuations on those stocks really come down, particularly for Nvidia itself. Is that an area where you think investors should be, hiding out perhaps in this market?
Yeah, it's such an interesting contrast. When you look at the start of the year, the market looked overvalued, and a lot of that overvaluation was concentrated in those Mag 7 names. In fact, they looked historically expensive, not as expensive as they were in late 2021, but still very pricey. And then you roll the clock forward to today, and the market generally looks expensive, and yet the Mag 7 are more reasonably priced. And when you think about the case for the Mag 7, the fundamental appeal that they have, whether it's from the earnings, the profitability, the balance sheet robustness, the AI theme that they're tied to, that's a lot of appeal from a fundamental perspective, and the valuations now are more approachable. So if we're looking for where the silver lining is in today's market price action or in this year's price action, I would say it's a decent time to be a Mag 7 investor.
Are you as excited, Marta, about opportunities overseas as some of the other strategists we have on the show?
Well, certainly the valuation argument has favored markets overseas and continues to favor market overseas. I think the one consideration that I have there is just kind of where growth prospects stand overseas relative to the U.S. I think that the U.S. has borne the brunt of the trade war, and I think at some point there will be some pain borne by markets overseas. I also think that when you get excited about the AI narrative, you can get excited for opportunities in China, certainly, and in the U.S., but it's harder to get excited about an AI narrative for Europe broadly. So I think that the valuation argument means that it makes some sense to lean overseas, but I think I would put a cap on that exposure.
Marta, always great to see you and to have you on the show. Thank you.
My pleasure.
All right, Dell earnings coming in now. Let's get you those numbers. This stock is shooting higher here, more than 7% in the after hours. Q1 adjusted EPS 155 versus 169. Revenue 23.38 billion versus an estimate of 23.15 billion. But now let's get to the guidance. They are calling for Q2 revenue 28.5 billion to 29.5 billion. The street was at 25.35 billion, and they see the AI server backlog that growing to 14.4 billion. The estimate, Julie, looks like it was 7.88 billion.
Yeah.
Healthy beat helps explain why the stock's moving higher.
Yes, most definitely. And I'm just looking at the statement here. So the company is talking about that they saw growth throughout their different core businesses here. So if you look at those core businesses, businesses, they have two main groups, right? They have the Infrastructure Solutions Group and the Client Solutions Group. In infrastructure, the revenue rose by 12%. As part of that, servers and networking up 16%, storage up 6%. So it's really that server business that we have talked about that is sort of tied to the AI data center trade that has been doing well at Dell. For the Client Solutions Group, there we saw slower growth. Overall, revenue was up 5%. Commercial client revenue up 9%. This was interesting. Consumer revenue, that's a place that's been lagging, saw a decrease of 19% there. So really the standout is, again, in servers and networking.
Very interested what they have to say about the PC market on the call. Any more color there? Consumer sales, corporate sales would be interesting as well. The AI stories you were pointing out, Julie, the company's AI servers, what do you think the AI order trajectory is going to look like, and what kind of color and insight they give us on there? You know, the stock heading into this print, I mean, it was basically flat this year. It was down about 40% over the past 12 months, but it's still a name that is, the street is very broadly positive on. The average target is still around 130 on this one.
I mean, remember, this stock sort of caught fire in 2024, in part alongside Nvidia and winning some of those data center contracts. It shot higher. It reached a peak in May. Actually, wait, what's today? May 29th. Its record high, look at this, was on May 29th, 2024. Exactly a year ago today, this stock was closed at 179.21. So you can see, obviously, it's down considerably from those levels.
Yeah, losing a bit of altitude here. We'll see what they say on the call.
Yes.
All right, meanwhile, the Trump administration canceling more than $700 million awarded to drug maker Moderna to develop a vaccine against potential pandemic viruses. For more, we're bringing in here Yahoo Finance senior health reporter, Anjali Kamani. Anj.
Yeah, like you mentioned, the NIH canceled more than $750 million in funding for Moderna. And this is something that the company found out just based on a notification to themselves, even though they were really expecting that to get into late stage development. They said in a statement, Moderna received notice that the Health and Human Services Department, remember, led by Secretary Robert F. Kennedy, will terminate the award for the late stage development and rights to purchase the pre-pandemic influenza vaccines. Now, we went out to HHS to understand what the rationale was behind this. And among other things, they mentioned that the mRNA technology remains, quote, under tested, and we are not going to spend taxpayer dollars repeating the mistakes of the last administration, which concealed legitimate safety concerns from the public. And in that, they're referring to the myocarditis that was evident in some males and some younger individuals. So this is really just the latest setback for the company. We know it's been pummeled. The stock is down more than 30% on the year. This is one of the latest. So we know that they pulled their filing of a combination flu and COVID vaccine earlier last week. Then we've got the NIH funding that's cutting the pandemic and bird flu. And then we've also got missing the Q1 estimates earlier this year. So just really telling a really hard story for this company. We know it's been under pressure because of the waning COVID revenues, and these are just some of those areas that were supposed to sort of plug that hole. And now, without those in the way, it's a question on what Moderna's viability is. Now, on the flip side, you do have some good news, right? The company is still working on a number of clinical trials with Merck on a cancer vaccine. It also has a partnership with Vertex on cystic fibrosis. So they do have a few other things going for them, but this is really a longer play for the company rather than any near term that they would have otherwise been able to take advantage of.
All right. Thanks, Anjali. Appreciate it. Let's get to some more earnings now. We've got Marvell Technologies first quarter numbers. Those shares little changed in after hours. First quarter earnings per share coming in at 62 cents. That's just a penny above what analysts had been anticipated. Revenue also largely in line at $1.9 billion. $1.88 billion was the average analyst estimate. And looking here at what the company is looking for the second quarter, it sees adjusted earnings per share of 62 to 72 cents. Analysts have been anticipating 67 cents, and it looks like its revenue forecast also, basically the midpoint of it, is in line with what analysts had been anticipating. So again, the share's not doing a heck of a lot in response.
Yeah, and the stock was already down plenty hard in 2025 heading into this print. I do see a statement from CEO Matt Murphy sounding a confident tone here, talking about record revenue, talking about momentum being fueled by strong AI demand in the data center and market, Revenue says benefiting from the rapid scaling of our custom silicon programs. Of course, that's what Marvell does, right? Making chips for data centers, networking, other equipment. Also talking about a AI investor event coming up on June 17th. So if you're in this name, you're circling a calendar on there. But you can see the stock down about 2.5%.
Yeah, now it's extending some of those declines, indeed.
All right, up next, we're digging into overlooked parts of the AI landscape. More market domination overtime coming up. Stay with us.
Nvidia has long been seen as the poster child for artificial intelligence. Wall Street's seeing it as a pulse check on the health of the AI ecosystem. However, there is more to the AI trade, of course, that investors may be overlooking. DVX Ventures CEO John McNeel is joining us now with a closer look. And in addition to being in venture capital, John, you all helped co-found an ETF that helps also look for these opportunities. So I guess, you know, Nvidia has obviously dominated this trade along with a handful of other names. Before I ask you for specifics, I'm curious sort of how you're framing it when you're looking for these opportunities. What criteria are you using? What growth areas within AI are you looking at?
Yeah, during my time at Tesla and Lipton and other stops in my career, I had some responsibility for building data centers. And so what we did was we took the build sheet of a data center, an AI data center, which is actually quite different than your regular data center. It's got a lot more fiber, a lot more power, obviously. And we took that build sheet and said, if you were going to build a stock portfolio out of this, what would it look like? And it turns out that Nvidia is a super small minority of what gets put into an AI data center. And so we wanted to give investors access to what the real AI infrastructure profit pool is. And that includes everything from the power generation to the power electronics, to the cooling, to the substrates, to the networking software that has all these chips talking to each other, et cetera. And so that's really how we formulated this ETF called AIS.
And walk me through that product, John. What are some of the names in that vehicle, in that product?
Well, you can imagine, like I would just start from the power source. You've got GE Vernova and others who are providing the gas turbines that are powering these data centers. As you know, the utilities and the grid can't respond fast enough to demand. And so these large AI data centers are finding their own sources of power, and they're putting that power in quickly, and that's in the form of natural gas turbines. Then that connects to power electronics that transform that electricity so that the data center can use it. Those are provided by companies like ABB. And then you come inside the data center, and the data center, an AI data center, has 4 times the fiber that a normal data center does. And Corning is a name that is really benefiting off of all that fiber. And then you've got network providers, substrate providers. We have a list of about 60 stocks in the AIS ETF that contribute to that build of an AI data center and the profit pools that are within that.
And I'm curious, when you're thinking about your private investments as well, if you're applying some of the same criteria, if you're thinking about it in the same way.
Yeah, we tend to think about it in a holistic way and start to look at places that people don't often look at first. And as you mentioned, Nvidia gets a lot of the headlines here, as does Marvell and some of the other chip suppliers. But when you open the aperture and say, okay, what really is involved in this super cycle of AI and the build out of the infrastructure around AI, then it really broadens to a whole different series of stocks that investors can participate in and participate in the super cycle. And as we've seen through the last couple of weeks of earnings, the large hyperscalers, Microsoft, Amazon, Oracle, et cetera, are all confirming their previously announced AI infrastructure investments. So if anything, this is not slowing down, and the long-term commitments remain. As the market is shifting to more and more demand and inference, as Jensen Huang referenced this week in his earnings.
John, I want to switch gears here a little bit because you are the former Tesla president, and Tesla is certainly in the news. Robotaxis on the way, John, as you know, in Texas, coming up here shortly. I'm just curious, John, as you think about Tesla's advantages in that market, How would you think about that? How would you frame that as it goes head to head with Waymo, which of course right now is far ahead?
Yeah, Waymo's got has 10 million rides now under their belt. They're the market leader. Tesla's going to launch with what Elon describes as around 10 cars in a limited street map in Austin, which I think I applaud. That's the right way to start. Start with safety first and make sure that the passenger's safe is the primary objective. But to your question on what advantages they have, Tesla's got a lot of cars on the road. They've got millions of cars in the car park. They're gathering a ton of data. And additionally, Elon's got one of the biggest GPU clusters in AI. He's got a 100,000 GPU cluster AI data center outside of Memphis. He mentioned last week that they're now trying to build a 1 million GPU cluster gigawatt AI data center. And so that data is flowing into some of the most powerful compute in the world. And so that's a real series of advantages Tesla has. But as the head of autonomy at Tesla described last week publicly, he feels like they're a couple years behind Google at Waymo. And that's probably right. They've got some real ground to catch up because it's much different running driver assistance software than it is running a driverless car.
Well, and I'm also curious where you come out on the whole sensors versus cameras argument, the kind of technologies that each company is employing, because all the data in the world is great, but you have a piece of hardware that it has to power, and that has to be safe. So do you have any thoughts on that?
Yeah, I'll kind of give you both sides of the argument. The one side of the argument, and this has been Elon's mantra, is that humans drive cars with 2 eyes. And so a car with 8 eyes is going to do better with full-time attention on the road. That's really the Tesla position. On the other hand, there are reasons why the others, Waymo and the leading Chinese autonomous companies, have applied both radar and LiDAR in addition to cameras. And that's because our eyes can't see well through glare. Our eyes don't see through the dark. Our eyes don't see around corners, and our eyes don't see well around weather. And cameras have that same challenge. They don't see well through glare, through weather, through the dark, around corners. LiDAR and radar do. And so from a safety perspective, there's the argument to be made that you really do need those extra sensors if you're going to be a lot better than the human eye and responsibly address those weaknesses just in vision versus some of the other sensors. Now, the argument that Elon makes to counter that is, hey, for every sensor set that I add, I now add delay in decision making, because there are often times where the LiDAR sensor doesn't agree with what the cameras are saying. And so then the computer has to decide, okay, which one's right and which am I going to follow? And I need to make this decision like super fast to avoid a potential obstacle. And so his argument is much faster compute, much lower energy cost. We ought to be able to do this with eyes. The others argue you can't do it with just eyes because cameras have the same failings as human eyes.
Finally, John, there's a lot to ask you about because, listen, venture investor, former Tesla president, GM board member. One final point I did want your take on, John. I'm just curious to get this. If the EV tax credit does get axed, John, in your opinion, that would mean what for the broader EV market? What could be some of the ramifications, the ripple effects?
It's a good question. I think the answer is kind of clear in data. When you look at markets around the world where the EV tax credits have been pulled off, demand falls between 20 and 30%. So you're talking about a 20 or 30% drop in consumer demand. Now, granted, that is in times where the price difference between an EV and a gas car has been greater than it is today. Today, we're approaching parity. But I think a lot of folks are concerned that we may be ceding the EV market to China. BYD, the EV producer out of China, is the largest and fastest growing car manufacturer and supplier in Europe, in South America, in Asia. And there's a real concern that the U.S. automakers may get left behind due to this policy, due to these policy decisions, because China is moving so fast in the rest of the world. And it's no secret that their EV manufacturers are heavily subsidized.
John, really, really fascinating perspective. We really appreciate your time today.
Nice to talk to you.
Thank you. Let's get to some more earnings now. Gap first quarter earnings coming in. The shares taking a large hit of 17%. It looks like that may have to do with some commentary around tariffs. Our Brooke DePalma is here with us now to give us more details.
Yeah, in the press release, the company said that their fiscal 2025 outlook does not reflect the potential effect of tariffs. That's far different than what we've been hearing from so many other companies, including Best Buy just this morning, that said that now their full year guidance includes the impact of tariffs. Very specifically, they said if these tariff rates remain, they could result in a gross estimated incremental cost of approximately $250 million to $300 million. Certainly not what Wall Street wants to hear here. And this was despite the company beating earnings, beating revenue, beating same-store sales growth. I also want to note that within their two key brands, Old Navy as well as Gap, they beat same-store sales growth expectations from Wall Street. But Banana Republic and Athleta missed expectations there. Athleta has been a brand that the company has been struggling to really reinvigorate. Though that brand within Gap saw same-store sales decline of 8% compared to the roughly 3% that Wall Street had expected. Another interesting point that I saw was that the company ended the quarter with inventory up 7%. We've heard so much about this. Did companies pull forward? This shows that they did. They said that they ended the inventory up $2.1 billion, was up 7% compared to last year, primarily resulting from earlier timing of receipts here. So certainly Wall Street not pleased with this report and not pleased with the fact that 2025 outlook does not reflect the impact of tariffs.
All right, thank you, Brooke. Appreciate it. Meanwhile, Costco, third quarter earnings there just now crossed the wire. Let's get you those as well. Q3 EPS 428 versus 424. Q3 total revenue 63.21 billion. Street was at 63.31 billion. I'm looking at Q3 total comp sales ex gas FX plus 8%. Consensus was closer to 6.99%.
Yeah, Brooke DePalma still with us. So give us a sort of the context here for Costco.
Yeah, well, shares up roughly flat in after market hours, and that's largely because of the fact that investors have been optimistic about Costco. They know that they tend to outperform in this environment where there's lots of uncertainty, lots of consumers seeking out value and consuming the best bang for their buck. And so what we saw is that taking a deeper dive at U.S. same-store sales growth, that was up nearly 8%, more than what Wall Street expected. Also higher in Canada, as well as international same-store sales growth. And if you take a look at Wall Street's perspective, there are 27 buys on Costco, 15 holds and 1 sell. And one thing that we've been reporting on so much is that this company has been expected to do well in this uncertainty, and certainly we're seeing that play out. We know that 1/3 of its sales in the U.S. are imported from other countries, but this is a big grocery business, and those are the kind of companies that we've seen do well, like a Walmart, because largely consumers are going there from groceries. They need groceries, and they're not really too concerned about higher prices if, hey, they need to put dinner on the table tonight.
Right, yeah. Well, right now, Costco shares just up about 2/3, 1%. Thank you so much, Brooke. And that'll do it for today's Market Domination Overtime.
Don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.